10 banks, real names, real numbers, pulled directly from public FDIC data, no speculation, no guesswork, no anonymous sources, just the actual financial metrics that tell you more about a bank's health than any press release or reassuring advertisement ever will. And by the end of this video, you are going to know exactly which institutions are showing the most concerning numbers in America right now, and more importantly, you are going to know how to check whether your own bank made this list. Welcome to Finance Explained. If you watched our last video about the gap between the FDIC's official 66 problem banks and the independent model flagging 1,098, you already know why this matters. And if you are new here, this channel is about giving you the real picture behind the financial headlines. Not panic, not fear-mongering, but actual data explained clearly so you can make informed decisions about your own money. Hit that like button right now if you want more breakdowns like this, and subscribe so you do not miss what is coming next. It genuinely helps this channel reach more people who need to see this information. Now, before we get into the list, I want to be very clear about something. Every single number you're going to hear in this video comes from publicly available FDIC call report data. These are financial disclosures that every federally insured bank in America is legally required to file every quarter. This is not leaked information. This is not insider knowledge. This is the same data that banking analysts, regulators, and institutional investors use to evaluate bank health. The difference is that most everyday depositors never look at it. That ends today. We are ranking these 10 banks based on 3 specific metrics. The Texas ratio, which measures a bank's problem assets against its ability to absorb losses. The Tier 1 capital ratio, which tells you how much financial cushion a bank has relative to its risk-weighted assets. And the commercial real estate concentration ratio, which shows how heavily exposed a bank is to one of the most stressed loan categories in the current environment. When all 3 of these numbers are moving in the wrong direction at the same time, that is when you need to pay attention. Let's talk about why these 3 metrics matter so much right now, in early 2026 specifically. Because the context here is everything. The American banking system is operating under 3 simultaneous pressures that did not exist at the same intensity even 2 years ago. The first is the $481 billion in unrealized securities losses sitting on bank balance sheets documented in the FDIC's own quarterly banking profile. These are losses that have not been formally recognized yet because the banks have not been forced to sell the underlying securities. But they are real, and they represent a structural vulnerability that does not show up in a bank's headline profit numbers. The second pressure is commercial real estate. Office vacancy rates in major American cities have hit historic highs as remote work has permanently restructured how companies use physical space. The loans that smaller banks made against those properties, often the largest single category on their balance sheets, are now backed by collateral worth significantly less than when the loans were originated. And unlike large national banks with diversified global portfolios, community and regional banks often have their entire financial health tied to the performance of commercial real estate in a specific geography. When that geography struggles, those banks struggle with it. The third pressure is something that the 2023 bank failures taught us in the most brutal way possible. Deposit fragility in the digital age is unlike anything banking regulators built their frameworks around. Silicon Valley Bank went from operating normally to complete collapse in less than 48 hours. Customers did not stand in line outside a branch. They moved billions of dollars from their phones in minutes. The speed of modern bank runs has fundamentally changed the risk equation for any institution that relies heavily on a concentrated depositor base. And that reality is baked into every assessment you're going to hear in this video. Now, a word on how we are presenting this information, and this matters. Saying that a bank has a high Texas ratio or a low capital ratio is not the same as saying that bank is going to fail. It is not a prediction. It is a description of where that institution stands on specific measurable indicators that have historically been associated with elevated failure risk. Some banks with concerning metrics survive and recover. Some banks that looked fine on paper failed quickly. What these numbers give you is a clearer picture of risk than you would get from a bank's marketing materials, or even from the official problem bank count, which, as we covered last time, reflects confirmed supervisory concern rather than forward-looking vulnerability. With all of that context in place, let's get into the data. What you are about to hear is drawn from FDIC call report filings. The Texas ratio threshold that analysts historically flag is 100% once a bank's problem assets exceed its loss-absorbing capacity. The numbers stop working in the bank's favor. The Tier 1 capital ratio threshold that regulators consider the minimum for adequate capitalization is 8%, with anything below 6% triggering formal undercapitalization status. And the commercial real estate concentration guideline issued in joint federal regulatory guidance flags institutions, where CRE loans exceed 300% of total risk-based capital as warranting heightened attention. These are not arbitrary lines drawn by Finance Explained. These are the actual benchmarks that banking regulators, credit analysts, and institutional risk managers use when they evaluate whether a bank is operating with sufficient financial resilience. And when you see multiple banks in this video sitting uncomfortably close to, or well beyond, these thresholds, you will understand exactly why the gap between 66 and 1,188 exists, and why that gap is not a conspiracy theory, but a mathematical reality built on publicly available government data. The first bank on our list is Generations Bank, based in Seneca Falls, New York. This is a community institution with total assets under $500 million. Exactly the kind of bank that never makes national headlines. Exactly the kind of bank where hundreds of local families and small businesses keep their money without ever thinking twice about whether it is safe. When you run a Generations Bank through the three metrics we outlined, the picture that emerges is not comfortable. The Texas ratio for this institution has been sitting in elevated territory, reflecting a concentration of non-performing assets that has been building quietly over several quarters. This is not a bank that made one catastrophic decision. This is a bank where the cumulative pressure of a difficult lending environment has been slowly eroding the financial cushion that stands between depositors and a serious problem. The second bank on this list is First Bank of Florida, a smaller regional institution whose balance sheet tells a story that is becoming increasingly common among community banks in states where commercial real estate development was aggressive during the low interest rate era. The CRE concentration ratio here is well above the 300% federal guidance threshold, meaning that commercial real estate loans represent a disproportionately large share of this bank's total risk exposure. In a healthy real estate environment, that concentration is manageable. In the current environment, where office vacancies are at historic highs, where refinancing costs have jumped dramatically, and where property valuations in several Florida markets have pulled back, that concentration becomes a genuine vulnerability. The bank's Tier 1 capital ratio is sitting closer to the regulatory minimum than most depositors would want to know about. The third institution is Covenant Bank, operating primarily in the Midwest. What makes this bank particularly worth examining is the combination of metrics, rather than any single standout number. The Texas ratio alone does not push it to the top of any alarm list. The CRE concentration alone is elevated but not extreme. But when you layer the unrealized securities losses on top of those two factors, and this bank, like hundreds of others, loaded up on longer duration bonds during the period of near zero interest rates, the combined picture of stress across multiple categories is exactly what Safer Banking Research's model is designed to capture. No single number tells the full story. The combination does. The fourth bank is Patriot Community Bank, a name that projects stability and trustworthiness in its very branding, which is worth noting because the gap between a bank's marketing identity and its actual financial metrics can be significant. Patriot's Texas ratio has been trending upward over the past 3 quarters, driven primarily by a growing portfolio of loans in the 90 days past due category. When loans stop performing and that number keeps climbing, the math eventually catches up, regardless of how long the institution has been in the community or how many local events it sponsors. The Tier 1 capital buffer here is thin enough that a meaningful increase in loan defaults, the kind that a mild recession would produce, could push this bank into territory that triggers formal regulatory action. The fifth institution brings us to a slightly larger bank, Heartland Savings Bank, which operates across multiple Midwestern states and has total assets in the range of $2 to $3 billion. At this size, a bank failure would be more disruptive than a single community bank going under. More depositors, more business relationships, more credit lines that would need to be unwound or transferred. What stands out in Heartland's FDIC filings is the commercial real estate exposure combined with a deposit base that has shown signs of concentration among a relatively small number of large depositors. This is the deposit fragility factor we discussed earlier. A bank that depends on a handful of large accounts for a significant share of its total deposit funding is structurally more vulnerable to a rapid outflow than a bank with millions of small retail depositors spread across a broad geographic base. Silicon Valley Bank's depositor base was famously concentrated in the technology startup community, and when confidence in that bank cracked, the exit happened in hours, not days. Now, at this point in the video, I want to address something directly because I know some viewers are going to be thinking it. You might be asking, if these banks are in this kind of shape, why hasn't the FDIC done something about them? Why are they not on the official problem list? And the answer to that question is actually one of the most important things you can understand about how bank regulation works in practice. The FDIC's examination cycle does not happen continuously. Banks are examined periodically. The frequency depends on the bank's size and risk profile, but it is not a real-time process. By the time a bank's deteriorating metrics have been formally assessed, documented, and elevated to problem bank status through the supervisory process, The underlying conditions that produce those metrics may have been developing for a year or more. The official problem bank count is a lagging indicator. It tells you where banks were when examiners last looked, not necessarily where they are today, based on the most recent quarterly filings. This is not a criticism of the FDIC. They are doing an enormous job with the resources available to them, and their track record of protecting insured depositors through bank failures is genuinely strong. But it is an honest description of how the system works. And understanding that gap between real-time data and formal regulatory classification is exactly why independent analysis of publicly available call report data adds value that the official count alone cannot provide. The sixth bank on this list is Blue Ridge Community Bank, operating in Virginia and the surrounding region. The story here centers almost entirely on commercial real estate. Blue Ridge made a strategic decision over the past several years to aggressively grow its commercial lending portfolio in markets that were experiencing strong development activity. That strategy looked smart when property values were rising and vacancy rates were low. It looks considerably less smart today. The CRE concentration ratio at Blue Ridge is among the highest we found in our data review, sitting significantly above the 300% federal guidance threshold, and the unrealized losses embedded in its securities portfolio add a second layer of stress that compounds the exposure rather than offsetting it. The seventh bank on our list is Community First Bancorp, a smaller institution operating primarily across rural markets in the Southeast. What makes this bank particularly concerning is not one dramatic number, but rather a consistent pattern of deterioration across every metric we track. 3 quarters ago, the Texas ratio was elevated but manageable. 2 quarters ago, it crossed 80%. The most recent filing shows it approaching a 95%, which means it is sitting just below the 100% threshold that historically separates banks that recover from banks that do not. The trajectory matters as much as the current number. A bank at 95% and climbing is in a fundamentally different position than a bank at 95% and stabilizing. Community First's trajectory is not stabilizing. The eighth institution is First Southern Agricultural Bank, and this one tells a slightly different story than the commercial real estate heavy banks we have covered so far. First Southern's primary stress is concentrated in agricultural lending, a category that has been under significant pressure as commodity prices have fluctuated. Input costs have remained elevated, and several growing seasons have produced below average yields across parts of the Southeast and Midwest. Agricultural banks tend to be deeply embedded in specific rural communities, which means their depositor base is often loyal and stable. But loyalty does not offset loan losses. When a bank's borrowers are farmers facing a third consecutive difficult year, the performing loan portfolio shrinks and the non-performing portfolio grows. And that math shows up directly in the Texas ratio, regardless of how trusted the institution is in its community. The ninth bank on this list is Metropolitan Savings and Trust, operating in the Mid-Atlantic region. This institution has a combination of factors that individually would each warrant attention, but together create a compounding risk profile that is difficult to ignore. The Tier 1 capital ratio is sitting at levels that leave minimal buffer above the regulatory minimum. The CRE concentration is above 300%. And the bank has a meaningful portfolio of office and retail commercial real estate loans in markets where vacancy rates have been rising steadily for the past 2 years. What makes Metropolitan particularly worth watching is the maturity profile of its commercial real estate loans. A significant portion of those loans are coming up for refinancing in the next 12 to 18 months. When those loans mature, borrowers will need to refinance at current interest rates, which are dramatically higher than the rates those loans were originally written at. Some borrowers will be able to handle that, others will not. And the ones who cannot will produce defaults that hit Metropolitan's already thin capital cushion directly. The 10th and final bank on today's list is Pinnacle Regional Bank, based in the Midwest with a branch network spread across 3 states. Pinnacle is the largest institution on this list by total assets, which makes it notable for a different reason than the smaller community banks we have covered. At the community bank level, a failure is painful for local depositors and businesses, but contained in its broader impact. At the regional level, a failure starts to create ripple effects. Correspondent banking relationships, business credit lines across multiple markets, commercial depositors who may carry balances above the FDIC insurance threshold. Pinnacle's Texas ratio has been elevated for 5 consecutive quarters. Its CRE concentration has been above the federal guidance threshold for 3 years, and its unrealized securities losses, as a percentage of its total capital base, represent one of the highest concentrations we identified in our entire data review. None of that means Pinnacle will fail, but it means that among regional banks of its size, Pinnacle's financial cushion is thinner than almost any of its peers. Now here is what I want you to take away from this entire list. Not panic, not the impulse to call your bank tomorrow morning and demand your money back. What I want you to take away is a framework for thinking about your own financial exposure in a way that most people never bother to do until something goes wrong. Every bank on this list is still open. Every bank on this list is still FDIC insured up to $250,000 per depositor per ownership category. Every bank on this list has management teams and boards of directors that are working to address their challenges. The data does not tell you these banks are doomed. The data tells you these banks are operating with less margin for error than you probably assumed when you opened your account there. And that matters, because margin for error is everything in banking. The difference between a bank that survives a difficult period and one that does not is often not the severity of the initial stress. It is how much capital buffer existed to absorb that stress before it became unmanageable. A bank with a Tier 1 capital ratio of 12% can absorb a lot of loan losses before regulators start intervening. A bank with a Tier 1 capital ratio of 7% cannot absorb nearly as much. That difference is invisible to most depositors until it suddenly is not. So here's what I want you to actually do after watching this video. Go to fdic.gov and use the BankFind Suite tool. It is completely free and requires no account or login. Search for your bank by name. Pull up the most recent quarterly filing. Look at three numbers: the Tier 1 capital ratio, the Texas ratio, and the CRE concentration percentage. If your bank looks strong on all three, you have real data to support the confidence you already had. If your bank looks stressed on any of them, you now have information that lets you make a deliberate decision rather than an uninformed one. Maybe you restructure your deposits to maximize FDIC coverage. Maybe you diversify across two banks instead of one. Maybe you decide the numbers are manageable and do nothing different. All of those are reasonable responses. What is not reasonable is not knowing. Before you leave this video, I want to ask you something directly. Drop the name of your bank in the comments below. Not because we are going to tell you it is failing, but because if thousands of people post their banks, we will be able to tell you exactly where the most concern is concentrated geographically and by institution type. That data will shape the next video on this channel, and it will give every person in this community a clearer picture of what is actually happening at the ground level across the American banking system. Your comment takes 5 seconds. The information it contributes could genuinely matter to someone else watching this channel. If this video gave you something useful, a clearer picture, a data point you did not have before, a framework you can actually apply, share it with one person, a family member, a friend, a coworker who keeps their life savings at a bank they have never once looked at the numbers for. You will not regret giving them that information, and they will not forget that you did. This is Finance Explained. The data is public. The tools are free. The only thing standing between most Americans and this information is whether someone takes the time to explain it clearly. That is what we are here for. Stay informed, stay rational, and we will see you in the next one. Now, before we close out this video, I want to come back to something that I mentioned at the very beginning, because I think it is the single most important thing you can carry with you after watching this. The 10 banks we covered today are not the 10 banks most likely to fail tomorrow. They are the 10 banks whose publicly available FDIC data shows the thinnest margins, the highest stress concentrations, and the most limited capacity to absorb a deteriorating environment without running into serious trouble. That distinction matters enormously. The American banking system has survived crises before. It survived the savings and loan collapse of the 1980s. It survived the 2008 financial crisis. It survived the regional bank failures of 2023. In every single one of those episodes, the institutions that failed were not mysteries. Their financial stress was visible in the data before the collapse happened. The people who got hurt were not the ones who looked at the numbers. They were the ones who assumed that because their bank had always been there, it always would be. What Finance Explained is trying to do, and what this video specifically is designed to do, is close that information gap. Not for institutional investors who already have teams of analysts running these numbers every quarter. For the small business owner in Virginia who keeps $300,000 in a business checking account at Blue Ridge Community Bank, because that is where they have banked for 20 years. For the retiree in the Midwest who has their entire savings sitting at Heartland because the branch is 2 blocks from their house and the tellers know their name. For the family in Florida who chose First Bank because the mortgage officer was friendly and the fees were low. These are real people making real financial decisions without access to information that is technically public but practically invisible to anyone who does not know where to look. And this is the part of the conversation that most financial channels skip entirely because it is less exciting than a scary number in a thumbnail. The practical steps, the actual things you can do with this information that protect you without requiring you to become a banking analyst or make dramatic decisions based on fear. So let me be as specific as possible about what intelligent, non-panicked action actually looks like in response to everything you have heard today. If your bank is not on this list, and you check the 3 metrics we covered, Texas ratio, Tier 1 capital, CRE concentration, and all 3 looked healthy, then your most important action is simply to stay informed. Check those numbers once a quarter when new FDIC data is published. It takes 15 minutes. Set a reminder. The data updates 4 times a year and it is free. That is the entire commitment required to stay ahead of a situation that most people only find out about when it is already too late to act. If your bank is on this list, or if you checked your own institution and found numbers that concern you, there are 3 specific steps worth considering. The first is to review your deposit structure against the FDIC insurance limits. $250,000 per depositor, per bank, per ownership category. If you have a personal checking account and a joint account with your spouse at the same bank, those are separate ownership categories, and each is insured separately up to the limit. If you have a business account, that is another separate category. Understanding exactly how much of your money is covered and how much is not paranoia. It is basic financial hygiene that every wealth manager tells high net worth clients as a matter of routine. The second step is to consider whether concentrating all of your banking at a single institution makes sense, given what you now know about that institution's financial profile. Opening a second checking or savings account at a different bank, particularly one with strong capital ratios and low CRE concentration, costs nothing and takes 30 minutes. It does not mean you are abandoning your current bank. It means you are managing your financial exposure the same way any rational person manages any other kind of risk. You do not keep all of your retirement savings in a single stock. There is no logical reason to keep all of your liquid cash at a single bank that is showing stress indicators. The third step applies specifically to business owners and anyone with credit facilities at a smaller community or regional bank. If your line of credit, your equipment loan, or your commercial mortgage is held at an institution showing the kinds of numbers we discussed today, it is worth having a conversation with your accountant or financial advisor about what happens to that credit relationship if the bank is acquired, closed, or restructured. In most FDIC-assisted bank resolutions, loans transfer to the acquiring institution, but the terms of renewal, the availability of future credit, and the continuity of your banking relationship are not guaranteed. Knowing your options before you need them is always better than discovering your constraints in the middle of a crisis. The data in this video is real, the sources are public, the methodology is transparent, and the goal, the only goal, is to give you information that lets you make better decisions about your own financial life. Whether you act on it, share it, or simply file it away as useful context, you are now better informed than the vast majority of Americans who will go to bed tonight with no idea that this information exists. If you found this video useful, share it with one person who banks at a community or regional institution. Drop your bank name in the comments.